Who would have known that 2 weeks after the shock outcome of Brexit that the strategy would have been to buy everything, maybe except for oil? Is an inflection point at bay? Let's talk more with Nicholas Ferris, Investment Director, Eastspring Investments, and Nicholas Wilcox, Executive Director of JP Morgan Asset Management's European Equity Group. Gentlemen, so we have two Nicholases right here on the show. Welcome. Great to have you with us. So, it's absolutely bizarre, this strange exuberance by gold, by equities, by bonds. Is there any reason to believe that maybe even the U.S. earnings season might surprise us and this risk momentum keeps on going?
Well, actually, Claire, I think what we're seeing is actually the opposite of exuberance. It's actually been motivated by fear, not greed. So the outperformance of bonds in particular, and then bond-like equity, utilities and consumer staples, has actually been very much a defensive-led rally.
Given that everything has become so expensive, what do you buy?
Yes, bonds are expensive, but not cyclicals. Cyclicals, in fact, are trading at probably their biggest discount since 1999 in relative price terms and almost in valuation terms. So actually, the way we've been positioning our portfolio is to buy European equities. We're overweight European equities, Italian equities, Austrian equities. On UK Independence Day, I bought FTSE 100.
You did very well. FTSE 100 is up 70% year to date.
That's
Sterling,
right.
Hope you've hedged your currency.
Actually, I didn't. We took on sterling as well because sterling had fallen a lot. We did buy Japanese equities hedged though as well. So we've taken a more constructive view on cyclicals and value. How
critical are the problems in the Italian banking sector? Non-performing loans, 1/5 of the country's GDP, and in fact, the GDP itself has been downgraded by the IMF.
This isn't a new problem. This has been around for decades. The non-performing loans, as you say, are a large percentage of GDP. Estimates at the moment somewhere between 150 and maybe 250 billion euros. So these are big numbers. But ultimately, they are being dealt with. The European Banking Union has undergone these numerous stress tests. We saw the initial outcome of these back in 2014. The next tranche is coming through as we speak, which is what's brought this to light. But I think we are nearing the end of this story rather than at the beginning, and I think we will see some sort of resolution.
As negotiations continue between Brussels and Italy, ultimately it comes down to what sort of conclusion they reach. Are they going to do a bail-in? Are they going to do a bail-out? As Matteo Renzi stakes his political career in October, is there any chance that the banking woes of Italy will actually turn into a seismic and even systemic problem?
Potentially, but I think you need to remember that the Italian referendum in October is very different from what we've just seen in the UK. This isn't an in-out vote for Europe. This is Renzi trying to essentially shore up the Italian political system. And as such, yes, we might see a little bit of movement around the margin. And remember that the Italian banking system, the problem that Renzi has right now is that there are a lot of retail, essentially deposit holders who were rightly or wrongly moved into junior debt, and so they potentially are the ones that will lose out if we see a bail-in. And yes, that might have ramifications come October's referendum, but it's certainly not as extreme a vote, or the implications of the vote are certainly not as extreme as we've seen in the UK in recent weeks.
So given the huge sell-off that we've seen with the Italian banks, and you're buying them, is it because of the cheap valuation? You do believe there's going to be some political backstop?
We've got a position in Italian equities. We've had that for some time, and we've been increasing that more recently into the sell-off. Italian equities are trading at 0.7 times book value. Earnings are 40% below trend. So we think there's a significant upside if there's some sort of normalisation.
Yeah, but you've got to be able to sleep at night, right? But when all said and done, what about this risk of contagion across the pond? After all, we do have the U.S. earnings season kicking off, and it's probably not going to be pretty.
I think there has been some inflection in the leading indicators of earnings. So I look at the ISM index, the manufacturing survey, which does tend to sort of be a quite decent leading indicator of profits in the US, and there has been an inflection point there. I wouldn't be surprised if there's further weakness or downward revisions in bank sector earnings, for example. But again, the banking sector in the US is trading at a 60% discount to the broad US market. So I would actually look to take on US banks as well.
If there are any surprises or any sort of glimmer of hope, Is this actually another trigger for more upside in this global equities rally?
This is a move from extreme pessimism to a slightly less bad situation, and as such, any small incremental improvement in the data is currently having quite a large impact. So you're absolutely right. If we see Q2 earnings not disappointing as significantly as people expect, we may see that as the next catalyst for the next leg up.
So Nicholas, both of you, thank you so much for that.